faithfully delivering value, interpreting great books worldwide. Hello, this is Sally's Book Talk. Today we're interpreting The Man Who Beat the Market. The subtitle is From Las Vegas to Wall Street. This is the autobiography of its author, Edward Thorp. Thorp's life is full of legendary tales. He was a bit of a mischievous genius kid, a brilliant young scholar, a gambling legend in Las Vegas, and a financial giant on Wall Street. His life is an exciting adventure about scientific gambling and investing. In this journey, Thorpe turned gambling and investing into strict math models and odds calculations. He cut through the fog of luck and chance, reaching the core of strategy games and market swings. And amid uncertainty, he carved out a path to wealth and success. Kirkus Reviews, a famous American book review magazine, called this a must-read for every potential investor. In this book, Thorpe shares his life experiences and insights from childhood to old age, spanning over 80 years. He tells thrilling stories of outsmarting casinos and sums up lessons from decades of investing. And then, from the complex and shifting market theories, he distilled refined principles and wisdom that I believe will inspire you. Now, let's step into the legendary life of this investment master together. I'll break down this book into 3 parts for you. Part 1. How did Thorpe beat the house in casinos? Part 2. How did Thorpe conquer the market? Part 3. What investment advice does Thorpe give to everyday investors? First, we'll cover Part 1. How Thorpe beat the house in casinos. Before diving in, let's briefly explore Thorpe's life. You might ask, how can a scholarly professor also be a gambler? 2 roles that seem worlds apart? That brings us to Thorpe's upbringing. Thorpe grew up in Chicago with his parents and younger brother. His dad was a World War I vet who later worked jobs like lumberjack and security guard. Thorpe's mom was born in the Philippines and worked as a riveter at an airport. Despite a modest income, Thorpe even worked as a paperboy to save for school. Yet, his parents valued education, squeezing money to buy books. This respect for knowledge quietly shaped his attitude toward learning and exploration. Thorpe showed remarkable talent from childhood, exceptionally intelligent and intensely curious. You could say he was a child prodigy. For instance, his memory was extraordinary. At age 6, he could effortlessly recite the names of all English kings and queens. Another example, he mastered skills rapidly. At 8, he learned chess and soon defeated adults around him with ease.
He was also passionate about science experiments, even making homemade explosives once.
Due to family poverty in his teens, Thorpe needed to fund his own college education. He won first place in a Southern California high school physics competition, beating top students, earning a UC Berkeley scholarship. In college, he earned bachelor's and master's degrees in physics. During PhD studies, he discovered his mathematical strength, switched to math, earned his doctorate, and became a mighty professor. While researching, Thorpe grew fascinated with gambling probabilities after a Las Vegas trip where he knew little about casinos. He played small-stakes games, lost most money, but noticed even skilled players ignored the math, assuming gambling was pure chance and beating casinos impossible. This ignited fierce curiosity and exploratory drive in Thorpe, seeking winning methods. After returning, he immediately studied gambling strategies and developed card-counting systems to beat the house. Thorpe's core strategy calculated player win probabilities under various conditions, betting more when odds favored players, less otherwise. I'll explain using blackjack and roulette. Blackjack is also called 21. Basic rules. Players get 2 random cards, then choose whether to draw more. The goal is getting card values close to but not over 21. Exceeding it means busting and losing immediately. The dealer must keep drawing cards until their hand totals at least 17, after which they can't draw anymore. The player, though, can always choose whether to draw a card. That's the basic rule of blackjack. And then, plus, over time, blackjack has developed many variations, like splitting pairs of cards with the same value to play 2 hands at once. Here, we're just sticking to the basics, not going into specific gameplay details. Thorpe found that by studying the rules, the player's win probability shifts as the game goes on. If more small cards appear early, it means more high cards are left in the deck. Combining with the rules we mentioned, dealer must keep drawing, player can choose. Conclude, the more high cards left, the higher the dealer's bust risk, and thus the player's win rate rises. Based on this, Thorp used a computer to calculate win probability distributions for all scenarios, confirming his guess that the player's win rate links to the high to low card ratio in the remaining deck. But obviously, you can't bring a computer to the table for live calculations. For quick calculation and memory, Thorpe developed a simplified card counting method, also called the high-low strategy. The method: start at 0, add 1 for each low card, 2, 3, 4, 5, 6, do nothing for middle cards, 7, 8, 9, and subtract 1 for each high card, 10, Jack, Queen, King. When the count is above 0, it means more small cards have appeared, so more high cards are left in the deck. At this point, since the dealer must keep drawing, the bust risk increases and the player's win probability goes up. Conversely, when the count is below 0, the dealer's win probability is higher. When the player's win probability is high, bet more. When the dealer's is high, bet less. That's how you beat the casino statistically. After devising the strategy, Thorpe went to Las Vegas casinos to test it. It worked smoothly, but he quickly became a key target for casinos. The casinos used all sorts of tactics to hassle him, like refusing large chips, increasing shuffling frequency, and even poisoning his drinks. But Thorpe kept winning steadily. In just 30 hours, he doubled his money and never had major losses. Besides blackjack, Thorpe also studied another gambling game, roulette. Simply put, roulette is about guessing which slot the spinning ball will land in on the wheel. Thorpe believed this was a physics phenomenon. The ball's landing spot could be calculated based on its speed and trajectory. To test this idea, he set up simulated roulette wheels at home and in the lab, analyzing the ball's motion at each stage, and then returned to Las Vegas for real-world testing. For this trip, he invited a partner, Claude Shannon, the famous scholar and founder of information theory. Demonate and collaborative, they jointly developed a wearable device. The device had 2 parts, worn by 2 people. One was a computer for calculations, about the size of a cigarette pack. A button hidden in the shoe could be controlled by the big toe to record the ball's movement characteristics. The computer used this data to predict the ball's future trajectory. Now, the other part was a radio receiver that could pick up the computer's calculation results. The receiver was connected via a thin wire to a tiny earpiece, allowing the user to bet based on what they heard. And they took this device to the casino for testing. It generated profits quickly, proving the strategy worked, but was limited by the device's immaturity. For example, the wire connecting the receiver to the earpiece was prone to breaking, risking exposure of their method. To avoid trouble from the casinos, they had to shelve the project. Later, Thorpe wrote a book called Beat the Dealer, specifically introducing blackjack strategies. In 1962, the book was published to great acclaim. Many players went to Las Vegas using the book's strategies, and wearable devices for roulette also proliferated. This change hit casinos hard, even forcing them to pass a new law. This law banned players from using any device that could predict outcomes or analyze probabilities. More interestingly, the law specifically prohibited players from using strategy cards printed with any content from Beat the Dealer. Okay, that covers the main content of Part 1. To sum up, Thorpe beat the casinos and the dealers because he calculated the win probabilities in various scenarios using probability thinking and made betting decisions based on those calculations. Practical results showed these strategies beat casinos, both theoretically and in practice. While researching casino strategies, Thorpe also invested his gambling winnings in the stock market. He quickly realized investing and gambling share similarities. Both can be analyzed mathematically and require careful risk-reward balancing. And Wall Street? Well, it's essentially a gambling mecca bigger than all Nevada casinos combined. Thorpe began wondering if his gambling strategies could win in this Wall Street casino. So he started self-studying financial markets, launching his legendary investing career. In part two, let's explore how the author conquered financial markets. But first, we need to address a fundamental question. Can markets even be beaten? In the 1960s, the dominant theory was the famous efficient market hypothesis. This theory claims market prices accurately reflect all available information. If true, stock fluctuations would be completely random and unpredictable, meaning nobody could beat the market. Beyond pure luck, investors could hardly achieve above-average returns. Today, we know markets aren't perfectly efficient, with new fields like behavioral finance emerging. These study and explain market irrationalities and non-random stock movements. But back then, the efficient market hypothesis was the undisputed authority, so Thorpe's habit of personal verification kicked in again. Though a self-taught investor, he didn't blindly trust authority. He resolved to use his mathematical skills to find a market-beating method. In 1965, while self-studying finance, he read a pamphlet on stock warrants, what Thorpe called his eureka moment. Simply put, stock warrants are securities giving holders the right to buy company shares at a set price within a time frame, essentially options. Thorpe keenly noticed a key feature. Warrant values correlate with stocks. Higher stock prices mean higher warrant values. The practical results show that these strategies beat the casinos both in theory and in practice. While researching casino strategies, Thorpe also invested his gambling winnings in the stock market. He quickly realized that investing and gambling share many similarities. Both can be analyzed with mathematical knowledge and require careful balancing of risk and reward. And Wall Street can be said to be a gambling mecca larger than all the casinos in Nevada combined. Well, Thorpe began to wonder if his previous gambling strategies could win in this Wall Street casino.
So he started self-studying financial market knowledge, launching his legendary investing career.
In part two, we'll explore together how the author conquered the financial markets. Before addressing this question, we need to discuss a fundamental issue. Can the market be beaten? In the 1960s, the mainstream theory was the famous efficient market hypothesis. This theory posits that market prices accurately reflect all available information. If the efficient market hypothesis is true, then stock price fluctuations are completely random and unpredictable, meaning no one can beat the market. Beyond pure luck, it's difficult for investors to achieve returns above the market average. Today, we know markets are not perfectly efficient, and new important academic fields like behavioral finance have emerged. They study and explain irrational behaviors in the market, such as stock movements that aren't entirely random. But at that time, the efficient market hypothesis was the authoritative and prevailing view. Therefore, Thorpe's habit of personally researching and verifying everything came into play again. Although he was a self-taught investor, he didn't blindly trust authority. Finally, in part two, let's verify together whether Thorpe truly beat the market as he claimed. Note that outperforming the market isn't equivalent to beating it.
The former often relies on luck, while the latter means finding a statistically significant edge and profiting from it.
So how did Thorpe's investment performance measure up?
Take 1969 through 1979. Princeton Newport Partners delivered 17.7% annual returns versus S&P 500's 4.6%, with much lower volatility, proving Thorpe genuinely beat the market.
Now we enter part three, Thorpe's investment advice for ordinary investors. He focuses on three areas: risk management, compound interest, and index investing. First is risk management. Thorpe emphasized its importance from casinos to stocks. Here are two risk management methods. The first is the Kelly formula. We intuitively know to bet more when odds favor us, but exactly how much? That's what the Kelly formula solves. Original context by physicist John Kelly, it calculates optimal bets using probabilities rather than luck. The formula states bet percentage of capital equals win probability divided by odds. In blackjack, Thorp calculated win probabilities between 1% to 5%, with odds meaning average return per dollar bet. Thorp measured it at slightly over $1. Following Kelly, Thorp bet about 1% of capital during high win periods, a conservative approach below full formula recommendations. The Kelly formula helps avoid total capital loss, but Thorp warns it can cause significant asset volatility. For safety, users might bet half or less of the Kelly amount. Additionally, Kelly works probabilistically and isn't ideal for short-term investors when applied. The Kelly formula requires knowing exact probability of returns. When uncertain, use it more cautiously. The Kelly formula. The second risk management method Thorp introduced is vigilance against leverage. For example, when young, Thorp made a silver investment. Expecting prices to rise, he borrowed money to buy silver. That's leverage, which amplifies both gains and losses. Say you have $100 and borrow $400, using this $500 to buy a stock. If the stock rises 20%, selling gives $600. After repaying $400, you're left with $200. Ignoring temptation with reality. Compared to your $100 capital, that's 100% return, far above the stock's 20% gain. Tempting, huh? But markets don't always rise. If the price drops 20%, your $500 becomes $400, just enough to repay the loan, wiping out your original capital completely. That's a margin call. Account blown up. See? Leverage is a double-edged sword, boosting returns while magnifying risks. Back to Thorp's silver. Under high leverage, a small price drop triggered a margin call, a pivotal moment in his investing journey. Thorp reminds us, strictly control your leverage ratio. When using leverage, first ask, if worst case happens, can I bear the consequences? Thorp's second investment tip, fully harness compound interest. Compound interest builds wealth through continuous reinvestment, simply doubling and redoubling, helping amass fortunes. Let's see compound interest's power through a comparison. Imagine person A and B, each starting with $1. A is cautious. After each doubling, they save profits instead of reinvesting. After 10 doublings, A has the $10 profit plus the original $1, totaling $11. B, however, reinvests all profits each time. After 10 doublings, B has $1,024. Without compounding, A's wealth grows arithmetically, while B's grows exponentially. Even with identical starts, compounding wins. So how do we calculate wealth growth speed? There's a handy formula called the Rule of 72. This rule states, if assets grow at R% annually with reinvested profits, the doubling time is 72 divided by R. For example, buying a $1 million fund averaging 12% returns, per the Rule of 72, every 72 divided by 12 equals 6 years it doubles. Over 24 years, the asset doubles 4 times. That's 2 to the fourth or 16 times the original. The initial $1 million becomes an astounding $16 million after 24 years. Beyond understanding compound interest, what does it actually mean for us? Wealth accumulation is just one of its uses. We can apply this mindset everywhere. The core is valuing delayed effects, meaning exponential accumulation of tiny changes. Thorp credits this for balancing wealth, health, and free time. For instance, since college, Thorp prioritized fitness, spending 6 to 8 hours weekly on running, hiking, tennis, and gym workouts for decades. Thorp believes each fitness hour saves a hospital day later, making it a brilliant long-term investment. He also evaluates whether spending money saves time, like hiring drivers or cleaners, or paying premium to live near work. We can adopt this. Practice delayed gratification and rationally analyze time and money efficiency. Of course, compounding has negative sides too, like debt snowballing. Thus, Thorp advises paying off credit cards and reducing interest-bearing debt. Thorp's third recommendation, index investing. He believes it's the most suitable strategy for ordinary investors. Simply put, buying index funds. These funds hold all stocks in an index, weighted by market cap, replicating its performance. meaning their gains or losses match the index. Thorp recommends index funds for two reasons: risk reduction through diversification and lower transaction fees. First, diversification is easy to grasp because indexes cover a wider variety of industries and companies. About the second point, lower fees mean index funds trade infrequently, only rebalancing when components change, while actively managed funds trade more, passing commission costs to investors. So, there's all right, that covers the main content of The Man Who Beat the Market. We've explored Edward Thorp's legendary journey and wisdom across three dimensions: gambler, investor, and thinker. Briefly reviewing Part 1, How Thorpe Beat the House. Through probability research, he developed card counting methods to calculate win rates. Part 2, How Thorpe Conquered the Market. He calculated assets' true value using pricing models and executed risk hedging. Part 3, What advice does Thorpe offer ordinary investors? He suggests mastering risk management, harnessing compound interest, and considering low-fee diversified index investing. Thorpe's life was extraordinary. You might say his success came from being a genius. That genius can't be replicated, meaning no lessons for regular people. But in my view, while genius-level hard skills like IQ are hard to learn, soft skills, thinking patterns, habits, are transferable. Thorpe writes that self-studying diverse subjects from childhood built his critical, multi-angle thinking habits.
Facing mainstream theories like you can't beat the house or market, he tested them himself rather than blindly accepting.
We too can explore knowledge beyond our field. It broadens thinking and reveals new worlds. We can adopt Thorpe's lifestyle habits, valuing incremental compounding, practicing delayed gratification, and rationally allocating time and money. Finally, a reminder, while the book shares thrilling casino wins, Thorpe only acted after exhaustive probability research. Today, over half a century later, replicating this remains exceptionally difficult.
Knowing and abiding by the law and staying away from gambling is our wisest choice.
All right, this concludes our interpretation of The Man Who Beat the Market for you. Reading notes are below the audio. See you next time.